Well, what's going on, YouTube? In this video, we're going to talk about Delta Airlines, ticker symbol DAL. Year to date, this company's up 21%, course of 1 year, 20%, 5 years down 32%. So we're going to talk about a quick little news with this company. Then we'll hop over to the financial statement, see how their financials are looking, and then figure out a fair market value for Delta Airlines. So one of the first things we want to talk about with Delta is the rising oil prices. And there is some potential macroeconomic headwinds as well. I do agree with that. But I think the macroeconomic headwinds is going to be attributed to these rising oil prices. Obviously it's getting more and more expensive for people to drive their vehicles and just run gas overall, right? So we can see here our gas prices currently are sitting just shy of $94 a barrel. If you kind of disregard the 2022 peak here that we had, we're really not, we're trading near all-time highs. This was back in 2014 here. So it's up there for sure. So we have to kind of wait and see where that goes, but that could definitely, I think the higher oil prices go, the more it's going to impact airlines overall. Because obviously it costs a lot of money for these airlines to run jet fuel and all that. So let's take a peek though at the financials. Because we were just talking about jet fuel and all that stuff, let's take a peek at the income statement here. So we can see our operating revenue. In total here we had 28.3 billion compared to last year at 23 billion. So, and this is 6 months, by the way. So passengers, in terms of, revenue, was $23.6 billion, up 24.2% from last year. So really solid on that side of things. Their cargo and their whatever their other is, obviously is not doing too great, but that's kind of more nominal numbers compared to their main core of their businesses, their passengers here. So we come down here to operating expenses. I put a little note in here. We have a $1.3 billion increase. I put it on like, is that potentially from the strike that happened with, it was another airline, I think it was American possibly. And I'm wondering if maybe there wasn't some negotiations made within this company as well that increased their overall salaries and stuff like that. Or maybe it's because they're flying more. That's possible too. So those are the two things that scenarios I thought of with that. But either way, obviously, if you're flying more, you need more, requires more labor to make up for that. So that's quite possible. There could also be a bit of a strike increased price for some of these pilots and stuff too. So the other thing we can see is the fuel and related taxes that they've got. So actually down year over year, but this is probably going to blow up quite a bit because of the price of oil. So, this is going to blow up. This could potentially, obviously they're going to charge more money for each one of their tickets, their seats, but is it going to be enough to offset how much this is going to grow? Because if we come down here, this company doesn't make a whole heck of a lot of money with all this revenue. So a total operating expenses was $26 billion, okay? And we made 28.3. So it's a very expensive business to operate. It is 8% profit margin compared to last year, which was at 3.2%. So we come down a little further. Once we take out taxes and stuff like that, this company made $1.46 billion in the last 6 months, which is a 5.1% of revenues. So it's a very, very tight profit margin company. Um, any economic turbulence, which we're potentially likely to see, is gonna is likely to push this company into the negatives, I think, just because of how much cost is associated with running an airline and how little profit is made from it. We'll come back up to the balance sheet. We've got 600 billion cash. We're down about 600 mil in the last 6 months. Just a little bit of a question as to why we're going through cash versus growing it, unless they're buying something. It's always a question as to why cash was uh, gone through, right? Overall, increased assets pretty nominal. A 2.2 billion increase from either the cost of more travel or people are willing to continue to travel more. So there is a about $2.3 billion increase for air traffic liability, which is just prepaid, plane tickets, right? So, could be a combo of both of those, where there is still more travel happening. Also, could also be a cost of increase in gas prices as well. And obviously, this is from June, so this is before gas prices really started picking up much more. So I'm really curious to see where that could be headed. This is probably going to impact their revenues quite a bit in the future here because of the cost of plane tickets. People don't need to go on vacations. They just want to, right? And if they are like looking at plane tickets and think like, "Oh, geez, that's really expensive," then they're probably not going to go on a vacation. So, oh, that's how I look at it anyway. Debt and finance leases ticked down nicely. In total, they got $65.5 billion in debt and $73.4 billion in total assets and only $6 billion in cash. Kind of a high debt, low income business, in my opinion. We take our cash provided by operating activities, 4.8 billion. We subtract out our combined here of our capex, 2.45 billion, gives us the annual free cash flow of 2.3 billion, or sorry, 2.3 billion on this one, annualizes $4.8 billion if they keep up this rate. So here's where they got rid of their cash and cash equivalents. It was mostly just you combine operating activities to your cash used in investing activities, and then also your financing activities. It gave you a negative $650 million. So that's where we lost our money. So we noticed they did pay down quite a bit of debt. So they paid back $3 billion in debt. So that's, if you're going to spend some money, at least it was used to, pay down some debt. That's okay. Overall, balance sheet doesn't look too terrible in my opinion. I mean, it's again, it's just a low profit margin business, and any type of turbulence in the business could throw you into the negatives pretty easily. So I don't like to see that. I would rather have a company that has 20-30% profit margins. That way, if something does happen, there's room to work with, and they're still going to be making money and not losing money. So that's what I see on this statement so far. Let's go more to the valuation spreadsheet. Company statistics. This company has a market cap of 2.5 billion with an enterprise value of 46.9. Lots of debt. They do offer a dividend. They have a 1% dividend yield. Return on equity is 46.8%. Return on invested capital is at 8.7%, so a bit low. We got our shares outstanding, 643 million shares. We noticed it ticked up year over year by just 1/4%. No big deal. That was probably from potentially options. That'd be my guess, since they didn't show any signs of stock-based comp or selling of stock. Gross margin 53%, operating margin 9%, profit margin 5%. Pretty tight. Price target on analysts is $57.80 a share. They have revenue growth of 2.4%, EPS growth rate of 34.5%. All right. Ratios, two ratios to take a look at, in my opinion, is return on invested capital. You can see over the course of time how our return on invested capital has trended, and it was in a downtrend for sure here. Appears to be picking back up. That's good to see. Our return on equity, well, this kind of throws things off, but we can see, for the most part, relatively flat. Peter Lynch valuation. Currently, we're at 10% return on invested capital. We have 3-year forward EPS growth rate, 14.7, growth rate of 5.2. So one thing that I changed was this growth rate is at 224%. So you combine 224, 12, 17, it's going to give you, like 60% growth rate. So I changed it to 15. I want to make it a more average number. We don't want to see 60% here because it just throws off the calculator so much. So I put 15 in, it's right in the line with everything else. So, and even when I did that, it still gave us a pretty good number. Peter Lynch fair value, $68.56. Multiples comparison. We got three other companies I compared to. $79.50. Manual PE. Only 8.8 years until we earn our market cap. So really good. Price to book ratio, total assets, all this. Price to book ratio is 317. 5-year average of 463. Our PEG ratio, 1.62. And so that's fairly valued. Our forward-looking peg is almost undervalued. Graham's valuation here. I gave this company a 1 in terms of growth. Gives them a intrinsic value of $96.11. Weighted average cost of capital, they got 3.37. Perpetual growth rate 2.5. I gave them a 35% free cash flow growth rate. Something else that I am looking at here is their free cash flow growth rate. So we can see in 2017, 1.1, 1.8, 3.5, negative 5.7. This is 2020. This is kind of what I'm talking about. If something happens in the economy, obviously there was like almost no travel, but if travel slows down too much, they're going negative, right? They're just not going to make money. In 2021, you can see when things were starting to pick back up a little bit, they're still barely making money. In 2022, same thing. You can see the gas prices. I wonder if the gas prices had a big thing to do with that. So as of right now, we just saw they're making $1.8 billion in free cash flow. So they're turning around, they're going in the right direction again. But once something happens and throws a little bit of turbulence, like I said, into the economy, it impacts this company quite a bit. It is not recession resistant whatsoever. So if we're potentially headed for a recession, this company is headed for it's got some headwinds. But keep moving. Gives them a negative DCF price per share of $95. Rule 72, got our EPS, current PE. Lowest EPS growth rate I found was 14.7, so we'll put 15 in. 15 goes into 72, 4.8 times. 4.8 goes into 10 years, 2 times. So we'll take double our EPS 2 times, so we get 18.6. 18.6 gives us a fair value of $139.50. 30% margin of safety of $39, or sorry, $97.65. So here we have our summary of all of our calculators. Gives us a average price of $57.68, purchase price of $40.38. Currently trading at $39.49. So based on the calculators, this company is trading with a 30% margin of safety, but actually slightly below. So currently trading at a good deal. However, it's trading at a good deal because of the current headwinds this company has. It, you know, we could see back here, analysts also are price target of $57.80. So, between the calculators that we just did and what they have, we're literally within 12 cents of each other. So, Wall Street has the same information, has the same graphs that we look at, same charts, same trend lines, all these other things, and they're not buying it right now. They're selling it because they know that they don't know where the future holds for this company because of the headwinds. We got rising oil prices. We've probably got a consumer that doesn't have as much money to spend for air travel anymore. So there's some potential for some negative uh, catalyst coming up for this company. So earnings could start falling in the wrong direction again. So it looks like a bumpy ride for sure for Delta in my opinion. But looking at the stock chart here, we are now locked in an uptrend. We haven't quite made new higher highs yet based on this weekly chart anyway, but we did hit a resistance point, a likely resistance point. Came up, hit it, pulled back. We are probably likely to retest this downward channel here, potentially come into this little pivot point of two trend lines, come out of there. That would be my guess. If we break below this, we're probably coming down to 27-ish dollars a share would be my guess. And then if we break below that, we're coming down to $20 a share. There's not much to hold this thing up in this range, but there is this. I think that's a pretty important area to look to accumulate shares. I don't think I would hold this for a long-term play. I think if it pulled back to here, depending on the current news, if things are looking not better, I would stay away until things start to look a little bit better for Delta. Maybe we got some insight from where if oil's starting to trend back down, if the Fed, we know the Fed is done raising hikes, which is pretty likely. Yeah, so I don't know. I just kind of sit on the sidelines a little bit on this one. It is based on calculations and valuations. It is trading at a 30% margin of safety. Also, the technicals here look pretty good. I would still just wait just a little bit longer here. Maybe $3 more of downside unless you're fine taking it here. and riding it down to like $35 a share. If it comes down there, it might not. It might come back, touch this trend line, and just bounce higher. Don't know. We have no idea what's going to happen, but based on technicals, that's a likely scenario, that it pulls back maybe into this range here and then continues higher. So we'll have to wait and see. But overall, Delta Airlines financials look good. The technicals look good. The valuations come out great. Uh, the thing that's just not ideal is just how this company makes money, and it relies so heavily on the consumer, and gas prices throw a big wrench in everything. So when they got to raise their airfare prices, then people don't want to fly and pay that extra money. So that's it for Delta Airlines. If you like this video, drop a like, subscribe, and we'll be back later with another stock analyst video.